Hello, investors. It's Don Vandenbord, Senior Portfolio Manager with Revere Asset Management. Today is Thursday, October 13th, 5:17 p.m. Eastern Time, coming to you from St. Augustine Beach, Florida, with tonight's Revere Market Insight video. Crazy day in the market. We'll get into it, talk about changes that we made today, and also talk about something to never, ever do in the markets. Aren't a lot of absolutes in the market, but there's something you should just absolutely never ever do. Uh, let's dive into the trend gauge. State of the market, we're still showing correction, but big, big, big positive reversal today despite really disappointing inflation numbers. And this kind of leads into what to never ever do. We'll talk about that momentarily. So market leaders still showing neutral. 21 over 21 holding up extremely well. Switch the arrow from red to black, which is neutral. As far as the five major indexes go, all five are showing downtrends versus all three time frames that we track in these videos. That means the short-term 21-day exponential moving average, the medium-term 50-day moving average, and the all-important long-term 200-day moving average. So what happened today? CPI numbers, everybody was focused on them. They came out 8:30 a.m. and showed inflation is not moderating in any way, shape, or form. Big gap down. We were up 1% before the numbers came out at 8:30 Eastern. We immediately started plunging and ended up at the open down 2%. But that was it. That was the low of the day. The market put in a complete reversal 3 minutes in and finished with extremely strong gains on the day. Let's go through them. The G6, this is our 6 ETF composite of growth, keeps our finger on the pulse of the growth environment, up 1.7%. Value outperformed growth for the third straight day. Actually, 3 out of 4. Yesterday they were about even. Yesterday was a tight day. But small growth stocks certainly aren't leading this parade. And in fact, Cathie Wood's ARK-K was red on the day today. It's not easy to have a fund negative on a huge positive day like this in the market. But considering that 7 of her top 10 holdings were down on the day, and they're just garbage stocks, I really don't understand what in the hell she's doing. But I don't have to. I just monitor what she's doing, and it gives me some feedback on the market. S&P 500 up 2.6%, NASDAQ 100 up 2.35%, Dow up 2.8%, mid caps up 2.2%, Russell 2000 small caps up 2.4%, global diversified 60/40 stock and bond up 1.3%. In-house on the positive reversal, we took a step back into the market, up 0.41% on the day. I'll talk about the 4 buys that we did today. We'll go through the tail of the tape, and then I'll compare. I've been talking a lot about some attractive thin stocks that we've been monitoring, and when there are a plethora of liquid stocks that are acting well, it's not really something we have to pay attention to struggle to get into thin stocks. But when some thinsters have really great stories, really positive price action, and their volatility is on the low side, it certainly makes for an attractive combination. And I'll talk about why we bought HLIT today, and subsequently why we did not buy AEHR. When we take a look at the charts, we'll get into that. So let's dive in, and we're going to start with the same spiel that I give every video. Here's a daily chart of the S&P 500. We're not fear mongers here at Revere. We've been accused of it, but we're not. We're trend followers. When the trend is up, we're in. When the trend is down, we're out. And there are many shades of gray in between that. So let's go back to last October, November. The markets were trending very nicely above their 21-day exponential moving average. This is the green line above their 50-day moving average. That's the medium-term line, the red line, and above the all-important black line, the 200-day moving average. When things start to roll over, our stops will take us out of the market. There'll be some false moves to the upside. We'll suffer a couple of paper cuts on that. No big deal, because a big trend pays for all those paper cuts. And if the markets really start getting worse, you'll see the slopes of the short and intermediate term moving averages roll over, as we did in mid-January. If things get really bad, you'll break below the black line, the 200-day moving average, and that's when we get maximally defensive, as you can see on the newly updated chart of the last 13 bear markets. I say newly updated because we made new lows today, absolutely bounced off of them. So that means that we've chipped away 3% of the 38% that you need to get even if you took a full 27.5% drawdown from high to low in your portfolio. And don't give me any crap about we're diversified, because bonds have been garbage this year. Foreign stocks have been garbage. Emerging markets have been garbage. So you can be diversified, but if you're diversified into garbage, it's still garbage. So take a look at these numbers, especially the highlighted numbers. 6 severe bear markets since 1968. That means 30% or more lost. Average loss minus 44.5% means you need 80% to get back to even. We keep our clients out of the way of this because we participate in uptrends, but our first job is to control the downtrends. If you control your downside, your drawdowns, the returns will take care of themselves when the market returns back into an uptrend. That's what we do here at Revere. And if you're interested in an approach like this, reach out to me, Don at revereasset.com, or phone 855-REAL-WEALTH. That's 855-732-5932. You can also email my partner and Revere president, Dan Stewart. Guess what? It's Dan at revereasset.com. He is a CFA, the master of all things financial, and he will answer any questions that you might have about our strategy, and also let you know, give his opinion on what you're doing right now. It's never too late to sell as long as you have a plan to get back in, much to the chagrin of people that like to frown on people that do what we do, like trend following and market timing, say you got to be right twice. It's too hard, you can't do it. Okay. Don't, just because you can't do something, don't get in the way of the people that can do it, is my response to that. So here's the S&P 500. Here is the big positive reversal candle today. Looks a lot like 3 similar candles. Let's start with January 24th. Going lower, big gap down, big slingshot back to the upside. So what is the thing that you never, ever want to do? Short in the hole. That means when the markets are already stretched to the downside and you have a further move to the downside, like a breakdown, or in this case, a gap lower, do not short that, because there's always the threat of reversion to the mean and a snap backwards. Anybody early in the either pre-market after CPI came out or early after the market opened that shorted got completely burned today. You do not short when you're extended to the downside. That's called shorting in the hole, and it's a recipe for disaster more often than it's not. The proper places to short are bounces into resistance that fail and then roll over. So here, January 24th, stretch to the downside, gap down, snap back to the upside. February 24th, stretch to the downside after 6 out of 11 days down, gap down, just stretch too far to the downside, snap back to the upside. This one not quite as bad. On May 20th, stretch to the downside, little bit of a snapback, lower lows, undercut it again, but snap back toward the reversion to the mean, kicked off a little mini rally. I guess you could argue that this is one too, not as obvious, but May 1st, 2nd, 3rd, May 2nd, reversal off of the 200-day moving average, pretty harsh move down here over a week and a half, gap down, snap back to the upside. And you see when it snaps back, it goes to the 21-day exponential moving average. In this case, we got above the 21-day. In this case, we got above the 21-day, but only for a day or two. In this case, we failed at the 21. This was a false breakout too, but this led to a nice rally back above the 21. We'll see where this goes. We don't ever predict, but a couple of things today and a couple of reasons of why we got long. There was a major fib at 35.05. We undercut and recovered it, and then we just kept continuing higher. And once we reclaimed yesterday's range, the market really took off to the upside. We got back on the long side, 2 buys of 10% each on SPLG. That's the equivalent of the SPY. And then 2 buys on individual, 1 ETF, a triple ETF in energy, NRGU, and HLIT. And we'll see where this goes. It's very possible we pause at the 21, but this is a 5.5% range from low to high. It's rare. It's the first time that the range has been that large. The entire move down, we did have a range of about 5.5% from pre-market to the bottom on 9/13. And here's another situation of why not to short. Here's a breakdown. We snapped back to it, went sideways for a couple days before breaking down again. It's okay to short if you are consolidating for a few days and bounce back into a resistance area, in this case the declining ADMA, but here we were extended from pretty much everything. So shorting in the hole, losing strategy, don't do it. Wait to short into some resistance that shows some sort of weakness or failure. So that's where we are on the S&P 500. Let's go to the NASDAQ 100. Very similar, over a 6% range in the NASDAQ 100, low to high. Stopped right at the declining ADMA. The ADMA is the purple line here. It's our ultra short moving average, and very often the meat of a move is contained, at whether up or down. The meat of a move is contained by the ADMA. We do pay a lot of attention to it. To see where price is relative to the ADMA. We don't officially track it, but we're aware of it at all times. Dow Jones Industrial Average, huge snapback, also bounced off the equivalent of this 35,000. I didn't click the right one here. Dow Jones Industrial Average. Here we go. Undercut, reclaimed all the way back above the 21-day exponential moving average for the Dow. Bottoming at 28,661. This is about a 4%, 4.5%. Also want to note the stochastic on 3 of the 5 indexes never got into oversold. Only on the S&P and only on the NASDAQ did it, and that's mostly because of the heavy weight in tech stocks. So we got back into oversold, which is below this 20 level, and in all cases today, on the 5 major indexes and 5 of the 6 on the G6, we had a strong enough day to snap back up. When you snap back up from oversold, you're setting yourself up. There's no guarantees. We're always looking to just put the odds in our favor of a big move up from oversold to overbought, and you can take advantage of those moves even in a bear market, just called a bear market rally. So this is one day as of right now, but again, a lot of positives coming from this. First of all, we snapped back on negative news, recovered the gap down, maybe just short covering. We never know for sure. We still have 21 stocks easily on the 21 over 21 list. We have oils acting extremely well. There are pockets of strength, and we do have the stochastic snap back up from oversold on the S&P, on the NASDAQ 100. From oversold, and on the Dow didn't even get to oversold. We stayed up above this 20 area. Also on mid caps, we never got oversold. So these have been outperforming. In fact, we didn't even have the crossover with the moving average on mid caps. Snapped back up. You can see they bounced off this 400 area, big support area. And let's finally go to IWM, small caps. We did get to oversold here. But again, hooked back up from oversold. So 3 of the 5 actually we hooked back up from oversold right into the 200-day moving average. Jesus, this is IWM. What the heck am I doing here? Helps if I type correctly. There we go. This looks better. I didn't think it got into oversold, and now I know I'm not losing my mind, although that's always up for question. So note it didn't cross the moving average, didn't get into oversold, which is the note I made from my pre-video research. But anyway, right into the declining 21-day moving average on small caps here. Remember, small caps and mid caps did get above the 21 last week when we were trying to bounce off the bottom. Here's an undercut of the lows. Another reason not to short in the hole is because you undercut the recent lows. And you can see the stochastic hook back up. So all 5 of the indexes doing their thing today. Looks like a short-term bottom. We do take it, as always, day by day, and then we not only look at the indexes, we look at what sectors and then individual stocks within those sectors are acting well. Let's very quickly go through the G6. IWO, cross back up, never made it to oversold, bounced at this 200 area note, did not undercut the June lows. Anything that didn't undercut the June lows is showing relative strength just compared to what the S&P and the NASDAQ 100 are doing. And really, it's the selling in these massive tech stocks that has taken over the S&P 500 and the NASDAQ 100, and that's why they underperformed to the downside. But note what didn't undercut and just take it to the next step. That's an approach that we take. FFTY didn't make it to oversold, hooked back up, bounced at resistance. This did undercut its June lows. Note that, as this FFTY has a lot of momentum stocks in it. PDP, another momentum ETF in the G6, didn't undercut. Bounced right into the declining 21, never made it to oversold this time, and you see the hook up. Also there, QQQJ, this is the mid cap NASDAQ 100, made it to oversold, hooked back up. This did undercut. MDYG, this is mid cap growth. MDYG, mid cap growth, didn't undercut, bounced at the 60 level, never made it to oversold, stochastic hook back up, and then possibly the worst, one of the worst charts that you will find, ARK-K, making new lows, did undercut, did not hook back up, still trending lower. This is just hot garbage. Okay, so those are the ETFs that I wanted to cover, the growth ETFs and also the 5 major indexes. Let me go through a couple of other big asset classes quickly. A lot of people ask about these. Gold, put in a hammer, didn't undercut the recent low, but certainly finishing red today, even though the dollar was down, is not good. Gold is something that you want to invest in when it's outperforming stocks. Otherwise, there's really no reason to be in it. It moves slower. This can't get above its 50-day moving average. It's been in a protracted downtrend. There was one brief gap up in a panic back in March when Russia upped the escalation in Ukraine, and that was just a selling event, plain and simple. Yeah, it showed some relative strength recently, but the chart, it still sucks. Let's take a look at Bitcoin. BITO is the Bitcoin futures ETF. That's not so good. Trending over the moving averages, but a little bit of relative strength recently, hanging around the 21. But this has kind of been just basing for a while, nothing really to get excited about. Let's look at the VIX. Still trending above all of the key moving averages, the green line, the 21, and then the 50 and the 200, and it's above this 30 level. Since it broke above this 26, 27, 28-ish level, things have been very volatile in the market. You want to see it get below 24 to provide a tailwind to stocks. And then finally, bonds. We'll look at TLT, which was down today, but finished well off of its lows, did make new lows, didn't very clearly, it did not rally the way stocks did. Let's look at the yield on TNX. You can see it made new highs before reversing, still riding this 80 MA higher. So now let's take a look at HLIT, which we bought today. We've been talking about how to get into some smaller stocks that are considered illiquid, but meet the CAN-SLIM characteristics and are holding up extremely well. Look at the relative strength line on HLIT. This is really what attracted me to it. They had an investor day that kind of was a game changer with big volume for here back in September, much lower volume pullback to the 50-day moving average, and then big move out of this base. How many stocks broke out of a base and didn't come back into the base over the last 3 weeks? You can probably count them on one hand, especially ones that are considered growth stocks with these nice fundamental numbers, PE of 28 with growth numbers in 2022 and 2023 above the PE, which makes it a PEG ratio of below 1. Anytime you see that in a growth stock, it's got to get your attention. You've got these big blue bars of buying, and you've got the relative strength line, and you've got an big support here at the 13 level. Look at this on a 15-minute chart. Anytime you get down near this 13 level, buyers come in. So it's got huge support at 13. And an outside positive reversal today, not up as big as the markets, but it certainly didn't drop the way the markets did. And look at this relative strength line, so HLIT. Now this trades 1.2 million, but as Michael pointed out to me, and he's absolutely correct, if you look at the volume over the last 10 to 15 days, it's closer to 1.5, 1.6 million. Which certainly increases the liquidity based on the raw numbers that we look at by about 20, 25%. And it's only a $13 stock. I usually don't pay attention to these, but the metrics on this are intriguing from the standpoint of, and I'm going to bring up some numbers in that we use in our spreadsheet when we calculate volatility. HLIT's ATR is only 3.75. That's less than double of the S&P 500. Its beta is 1.08, which means it's only 8% more beta than the S&P 500. This gives it a Revere volatility factor by our calculation of 1.46. So the S&P 500 is a 1. This gets a 1.46. Not volatile at all. When you get into illiquid, and it trades usually with less than a nickel between the bid and the ask, so there's no spread in liquidity. So it checked all these positive boxes. We've been looking at this for a while. We finally went into it today. Now let's compare this to another thin stock, AEHR, which had a massive move higher on an earnings report last week on 10/7, up 24% in a day on 500% average volume. Lovely, beautiful, happy, buy it, right? Okay, if you bought that day, you were underwater. If you bought it anytime after the open on 10/7 and didn't sell until yesterday because it broke below the low of the gap up day. Good stocks don't do that. And look at the relative strength line in this compared to what we just looked at in HLIT. Now this trades 1.5 million shares. The time when the average daily volume share count ticked up was all the way back here in July. The line has been fairly consistent since then, so we'll get to stick with 1.5 million on this, and it trades at 1640. So basically the daily dollar volume is just about the same as HLIT is, but let's take a look at how volatile it is. AEHR has an 8.9% ATR. And that's not just because of this big gap up day. You can see how long the bars are on this. You can buy this at the perfect point. It could have a normal 1 ATR pullback and you'd be out according to O'Neill rules if you follow the 7 to 8% because it's single day ATR at 8.9% could blow you out of the water. Additionally, its beta is 2.16 compared to 1.08. That's double what HLIT is. So this was given a Revere volatility factor of 3.35 over 3.3 times more volatile than the S&P 500. It's very clear. It's not something. I'm not saying that this is not something that we would not get into because we think we've come up with a pretty good plan for scaling into these things. But the difference between HLIT and AEHR, two stocks that trade basically the same daily dollar volume but act completely differently and have totally opposite volatility pictures, there's no comparison. So that's why we went with HLIT today. So that's your comparison between those two and why we made that decision. So let's look at that S&P 500 again, and let's look at, and again, I'm talking about what we did with the portfolio. Here you can see the bottom made very simply. We came up here, based for a little while, and then we took off like a rocket and then really exploded when we got to positive on the day. Our first entry into SPLG was at 35.74. So basically right when we went green here. And the second entry, and that was the first 10%, the second 10% was at 36.45, and that was using the 5-minute pullback on the stochastic here when it pulled back and turned higher. We use that to make our second buy. So 20% into that, 1% into HLIT, and NRGU, very volatile. This is actually even worse than AEHR. It has actually, it's not. No, yes, it is. It has an ATR of 9.6%. This is a 3 times energy. It's 10 of the largest energy companies. I couldn't decide which one to pull the trigger on. So there were 3 or 4 in here that were extremely attractive in these top 10. It's 10% each of 10 big energy stocks. When it moves, it really moves. It's got a 9.6% ATR with a 2% beta. That gives it a 3.5% volatility factor, a little more volatile than AEHR, but it's a triple. Versus XLE or XOP, and stop below today's low, something we may be able to pyramid into. But I really like this after the 3 to 4 day pullback in a bunch of oil stocks that just pulled back to the 50 or the 21-day exponential moving average, bounced off of it yesterday, and followed through with strength today. Oils, I mean, just quite frankly, from a return standpoint, it's a leading sector. There's no arguing that. So let's get into the tail of the tape here now. So technical picture has changed from the tailwinds from red to green, with the indexes in 5 of the G6 having that stochastic hook back up. Put call 0.89, nothing to write home about. I did notice a bunch of people, and I kind of discounted it at the time. Even when we gapped down, the VIX was not moving higher this morning, and the VIX proved to be getting it right as we had that massive upside reversal. I know a lot of people know a lot more about the VIX than I do, but that certainly was a signal that we weren't going to sell off any further than we did. VIX down nearly 5% on the day, still above those moving averages, as I mentioned. Fear and greed ticked up 6 to 24. Huge positive reversals, a first check in the box of the bull case, but we're still operating under the bear case. Certainly don't have a clear rally, and we haven't reclaimed the 21-day exponential moving average. I talked about CPI, and my summary comment on that is inflation is not reflecting price stability. That's the term that Jay Powell always uses. Went from 3 days down and then a consolidation day to one big up day. Massive low to high, as I mentioned. Ranges, big positive outside reversal. We undercut and reclaimed the support area. We touched, and even I don't even have it showed here. I have it down below though, and that's that big fib level of 35.05. Alex pointed out when we reclaimed this fib today of 258.05 that it was an extremely bullish signal. So we kind of went from pre-market to being extremely bearish, but not going to go short, to looking for pockets of strength, and the pockets of strength showed up 3 minutes into the open. So you got to get with the program when the direction of the winds changed. So we undercut and reclaimed some support areas. 11 out of 11 sectors up today. Banks in particular had standout strength. A bunch of them report before the open tomorrow, so we got to check that. Bonds down, the dollar down, gold, silver, and gold and silver stocks down, and builders down. We will be isolating some tickers going forward after this news today, but our portfolio went from flat to 0.26 adjusted volatility / beta, 20% SPLG buy, 1% HLIT, 1% NRGU. Bottom line, huge positive reversal despite bad inflation numbers. When bad numbers cause you to go up, you don't have a negative reaction to bad numbers. You got to pay attention to it. Got back above some areas that were support that were broken to the downside, reclaimed them today, in particular this big area from 35.75 to 36.14. So that's the area I'm watching on any pullbacks. And then you've got these prior lows, 36.36, 36.47. So big levels to watch there, but for now, a big check in the column of the bulls today may just be one day. We don't predict. We'll watch how the price action unfolds. If it continues to act well, we'll put more capital to work. That's going to wrap it. As always, love to hear from you. The email is don@revereasset.com. The phone is 855-REAL-WEALTH. That's 855-732-5932. Remember, it's not how much you make in the market, it's how much you keep. That's why we're down about 9% on the year versus 25 plus. Well, probably closer to 24 now, year to date. So we've got a lot of quote unquote house money to play with. We can be a little more aggressive getting into these positions. But as always, we'll keep our risk parameters just the same way that they are. Never want to lose more than 0.2% on any one particular position. That's 0.2% of the overall portfolio. That means you can take 4% positions. If you get stopped out on all of them, you only lose 1% of your total portfolio. That's what we put at risk every time we step toes back into the market. We gained 0.4% today. So if that continues, we'll continue to press it. If it doesn't, we won't. And that's going to wrap it. And remember, as I always say, it's not how much you make, it's how much you keep. So this is Don Vandenbord wrapping up Thursday, 10/13, telling it like it is. Nothing but the facts here at Revere. Thanks for listening and have a great day.